This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
I'm going to start there from page 27. Consolidations, this is the basis, as you can see from the screen. This is the basis of question 1 for 25 marks. And it is important that you are competent and capable and confident in the topic of consolidations. This will be in the exam. It's a guarantee. So, page 27. Companies may expand organically by building up their business from their own trading, or if they want to do it quickly and take a great risk, then they can build up their business by acquiring other companies. And that's what we're looking at. You've got the illustration of Danguola, who owns 80% of Ramunas and 100% of Avaldus and 60% of Venantus and 3 subsidiaries. You're not going to be faced with that situation in F7. You may be faced with a similar situation in P2, but in F7 we only ever have the one parent company and the one subsidiary. And that gives us the basis for working 1. I suggest you follow these workings very carefully. I always set them out in the same way. I am never inconsistent on this, and if you set them out in the same regular, consistent way, then it should make the question 1 in the exam relatively straightforward. So question working 1 will always have a parent company and a subsidiary. Some people prefer to do it that way and put parent company, subsidiary. That will get you in trouble. If you do it this horizontal layout, that will get you in trouble at level P2, because you've also then got sub-subsidiaries, you've got indirect holdings, non-controlling. It makes it difficult and awkward if you set it out horizontally. It makes P2 difficult. So I suggest you always set it out with the parent company at the top and a subsidiary below. You'll see with Danguola that Danguola owns 80% of the subsidiary, Ramunas. That means that 20% must be owned by somebody else. This somebody else that owns 20%, they're called a non-controlling interest. And we'll meet the non-controlling interest sometime later on this morning. We'll come across them and see what role they play and what they're entitled to. But then we have the question, we have the point here that P owns 80% of S. So if S has got some tangible non-current assets, the parent company and the subsidiary, the parent company's got 100,000 tangible non-current assets, the subsidiary's got 50,000 non-current assets. Basically, consolidation is a cross-addition exercise. We're going to cross-add. So what's the cross-addition for the combined, the consolidated tangible non-current assets? And the key word here is control. The big word in consolidations is the word control. And I'm going to consolidate the assets that the parent company controls. So how much of that 50,000 does the parent company control? Well, a good answer, but wrong, would be 80% of 50,000, 40,000. That's wrong. I actually control all of those assets. I am in control of the subsidiary company. The parent company is in control of the subsidiary. So they control the whole 50,000. They don't own the whole 50,000, but they control the whole 50,000. So a simple cross-addition would say that the group tangible non-current assets was 150. But we're really getting ahead of ourselves here. We're going a little bit too fast. So if I can get back to the notes on page 27. Types of acquisition. When a parent company acquires a sole trader, not an incorporated business, not a company, but when a parent company, when an acquirer acquires the business of a sole trader, they're buying the assets and the liabilities from the sole trader. They're paying the sole trader money. The sole trader rides off into the sunset and disappears out of view. And I simply have bought the assets and the liabilities of the sole trader. And the double entry is straightforward. It's going to be debit the individual assets and credit cash if cash is what is being paid. So that's a simple exercise. You just get rid of the person who was carrying on their business in their own name. If I buy a partnership, it's the same. I'm buying the assets and the liabilities from the partners, and the partners will ride off into the sunset, and I've acquired those assets and those liabilities. But if I buy a company, I'm not buying the assets and the liabilities. Instead, I'm buying the share capital, the shares in the company. And the shares give me the right of ownership. So the shareholders' funds represent the net assets, and by buying the shares, the company still exists. If I buy a sole tradership, the sole tradership is ended, the business finishes, and I have acquired all their assets, their liabilities, their database, their customers list. That's what I'm doing when I buy a sole trader. The same with a partnership, because a partnership is just 2 or 3 sole traders working together, carrying on a business in common. But when I buy a company, I'm buying the shares, and the company continues to exist and will continue to file its financial statements with company registry. It will continue to account for its taxation with the taxation authorities. It continues to be responsible and accountable to its own shareholders, but I am the majority shareholder. I am the one that has now bought control. Are we clear so far? If I speak too quickly, tell me. If I use any words that you don't understand, tell me. Let me know, and then I can try and explain it again in a different way. So if we read those 5 bullet points at the bottom of 27, if we acquire a sole trader, we acquire individual assets and liabilities, and I add them to my own statement of financial position because I now own these assets and liabilities. Profits and losses, which the sole tradership would generate, are now under my control and reported in my statement of income. If I acquire control of another company, then I do it by buying the shares rather than by buying the individual assets and liabilities. The investment in my books, in my own records, that investment is recorded at cost. It's represented by the ownership of shares, and that ownership of shares then gives me control. After the transaction, the acquired entity will continue to exist as a separate legal person. We've got an example in illustration 2 on page 28. The statements of financial position of Vytautas and Gediminas at 1st of January are as shown. Down at the bottom of the box, Vytautas acquires 100% of the share capital of Gediminas on the 1st of January for 3,000 cash. Under IFRS 3, the investment can be recorded in the parent company's books in one of 2 ways. It may be carried at cost, or it may be accounted for as an available for sale asset. It says, as described in IFRS 9, that will be wrong. It's an available for sale in IFRS 5. So we need to change IFRS 9 to IFRS 5, assets held for sale. The alternative way of recording it in the parent company's records, IFRS 5, assets held for sale, not IFRS 9, financial instruments. And the third bullet point there, in these notes it's assumed that the investment is recorded in the holding company's records at cost, and it will remain at cost forevermore. It will continue to be shown at cost, year after year after year. So example 1, can you show how Vytautas will record this investment and then prepare the revised statement of financial position? Vytautas will record it as debit investment in Gediminas credit cash. And so in Vitautus' own records, the cash figure, which is in the box at the top of page 28, the cash figure will go down by 3,000. And a new asset is created, investment in Gediminas. So in answering the second part of this exercise, investment in Gediminas 3,000, PPE, property, plant and equipment, 50,000, inventory, 8,000, receivables, 6,000, cash was 4,000, we've spent 3, so cash is now down to 1,000. So the assets of Vitautus, just Vitautus, the question doesn't ask us to prepare a consolidation. It's just asking for Vitautus' own statement of financial position immediately after the acquisition of these shares. So 68,000 is the total. And then we have share capital, 40,000. Retained earnings of 20. And current liabilities of 8. It gives me a balancing balance sheet. At the top of page 29, after the lines there, the features of the parent company's statement of financial position. This investment in Gediminas, this 3,000, will always be there. That's how much it cost the company to buy the shares and buy control of the subsidiary company. It will remain the same. It remains unchanged from year to year. Other net assets remain unchanged, reflecting only those assets and liabilities controlled directly by Vitautus. So it's its own balance sheet. A separate single legal entity company prepares its own financial statements. But then we've got a year later, in illustration 3, respective statements of financial position are now shown. And if you look at Gediminas now, a year later, after we've acquired it, the Gediminas retained earnings are now up to 9,600. They were only 2,600 at the date of acquisition. So whilst under our control, Gediminas' value has increased by 7,000. Shareholders' funds, the subtotal of share capital plus retained earnings, shareholders' funds were, at date of acquisition, 3,000. Shareholders' funds are now 10,000. So there's been an improvement of 7,000 in the wealth or the worth of the subsidiary company. But if all I show the Vitautus shareholders, if all I show them is the Vitautus balance sheet, I've got the investment in Gediminas still at 3,000. But that 3,000 investment has generated extra profits of 7,000 in Gediminas the profits in Gediminas achieved under my control have increased by 7,000. And if all I do is show them the Vytautas financial statements, that clearly is not giving them sufficient, relevant, accurate, representative information. And therefore we need to prepare an additional set of financial statements, the consolidated or group financial statements. The question at the bottom of the table of figures in illustration 3, is Vytautas providing its shareholders with useful information? Clearly not. If all I do is show them the Vytautas financial statements, then that's not sufficient. It's not clear. It's not representative of the true situation. While under Vytautas ownership and control, Gediminas net assets have increased significantly. And the solution then is to prepare a set of consolidated accounts. But on page 30, all is not quite so simple. The type of additional accounts we prepare depends very much on the percentage holding that the investing company holds in the invested company. It could be, as it shows on the size of the investment, if I own just greater than 0%, but I own less than 20%, what influence do I have? Well, the answer there is that it's 0 to 20, or less than 20. The influence is not significant. It's not significant. It's an insignificant interest. The accounting treatment is then to treat this investment as literally just as an investment, and we will account only for dividends received. We're not going to consolidate. This will not be a set of consolidated accounts. It's just as though you, personally, had acquired some shares in your local telephone company. You're not going to consolidate those results. It's simply an investment that you have in that local telephone company. So you'll account for the dividends as investment income, but you don't have any sort of control or even a significant influence over the activities of the local telephone company. That's not likely to happen in the exam. If I have greater than or equal to 20 and less than or equal to 50, then it's presumed that I now have a significant influence. And if I have a significant influence, then the accounting treatment is called equity accounting. And we'll come across equity accounting later tomorrow morning. Equity accounting. And this company, where I have a significant influence, is called an associate company. It's an associate. It's not a subsidiary. I don't have control. I have less than 50%. So I don't have control, and therefore I'm not in control of this invested company's assets, liabilities, profits. I have no control. I have an influence. I have a significant influence, but I don't have control. If I own greater than 50%, then I do have control. Even if it's only 50.000001%, if I own greater than 50% of the voting rights in this other company, then I have control. It doesn't matter how many of you get together and vote against what I want to do, I have the majority of the shares, I have the majority of the votes. And what I want to do is what will happen. What you want to do, I really don't care. I have control, not you. And the type of accounting here is called acquisition accounting. And once I have control, I have a subsidiary. And if I have a subsidiary, then I need to prepare consolidated or group financial statements. It's interesting to note, I think it's interesting, you may not be interested, but I think it's interesting, that if I have a company where I do have greater than 50% control, then I will prepare group financial statements. But if the only investment that I have is between 20 and 50, and I have a significant influence, then consolidated financial statements are not prepared. It's treated as an investment. If I have a subsidiary and an associate, then because I have a subsidiary, I will prepare group accounts. But if my only investment is an associate, then I will not prepare group accounts. It's only in the situation where a parent company has one or more subsidiaries that group accounts will be prepared. Provided Vitautas, back on page 30, provided Vitautas has a controlling influence, it's required to produce an additional set of financial statements aiming to record the substance of its relationship with Godiminus rather than its strict legal form. The strict legal form is that Godiminus is a company in its own right. It exists in its own right, and if Vitautas disappears, Godiminus will survive because it is a company and it has an indefinite, perpetual, therefore, existence. But the substance of the relationship is that not only do I control my own assets, but I also control the assets of the subsidiary, and therefore we have to prepare this additional set of financial statements. And you've got there the consolidated statement at the bottom half of page 30. Non-current assets, just looking at page 29, you're going to have to go backwards and forwards here. Non-current assets, plant and equipment, Vitautas has 55, Godiminus has 10, so under Vitautas' control there's 65,000's worth of tangible non-current assets. Current assets. The current assets of Vitautas were 20, the current assets of Godiminus are 12. The current assets under Vitautas' control are therefore 32. But notice that the asset in Vitautas called investment in Godiminus has disappeared. That investment in Godiminus disappears. On the consolidation, the investment in the subsidiary is lost. Still coming down page 30, in the bottom section of the balance sheet, and I do refer to it as a balance sheet, I should technically refer to it as a statement of financial position. The lower half of that statement of financial position, share capital. Vitautas had 40, Godiminus had 400. Ignore the share capital of the subsidiary. It is not cross-added. So you can write against that 40,000 in the consolidated financial statements, you can write against it, it's always, only, ever the parent company. Share capital is always, only, ever the parent company's share capital. It is not cross-added with a subsidiary. It's the one figure you can always put into a consolidated statement of financial position. All the others, many of the others, will require adjustment. But this is the one which doesn't. It will always, only, ever be the parent company. And that holds true right the way through your P2 studies as well as your F7. It's always, only, ever the parent company. Retained earnings is a bit of a problem. Retained earnings in Vitautas was 25. Retained earnings in Godiminus is 9,600. And the total figure is 32,000. And we need another working to show this. to calculate the consolidated retained earnings. It's working 3. Working 2 we will come to. I'm not forgotten working 2, but working 2 we will get back to.